Okay, it looks good. The room is packed. So let's get started. Good morning, good afternoon, and very welcome from wherever you're connecting today. Thanks for joining us to this webinar on broad debt pause clauses and increased transparency in emerging market sovereign debt bonds. This is a bondholder proposal, and we're really excited to unpack this with you today. My name is Mario Hutzel, and I'm a senior policy analyst at the Sustainable Sovereign Debt Hub. And together with our partners at EMEA, the Emerging Markets Investors Alliance, we're delighted to bring this conversation to you today. We hope that this webinar gives you fresh insights into how broad debt pause clauses and increased transparency can effectively strengthen resilience in sovereign financing. Before we hand over to our excellent panel, let me quickly walk you through today's agenda. We'll kick things off with welcoming remarks from Barbara Oldani. She's the lead of the Sustainable Sovereign Debt Hub. Then Barbara will be followed by Rue Ferguson. He's the head of international debt and head of the UK delegation to the Paris Club at the UK Treasury. He will give his remarks on the London Coalition. And then we'll finally turn over to the Bondholder Working Group, co-chairs Abby McKenna, Senior Advisor at EMEA, and Ben Heller, Portfolio Manager at HBK Capital, who will introduce the broad debt pause clause proposal today. And finally, last but not least, Starla Griffin, Senior Advisor to SSDH and leading the London Coalition Secretariat, will guide us through a moderated Q&A session with the panelists and share her closing remarks. Now, before we move on, speaking of Q&A, you'll find a little Q&A button at the bottom of the screen. Feel free to send in your questions throughout the conversation. We'll gather them as we go, and then Starla will present them at the end if we have time. I think that is it. I'm very much looking forward to this discussion. And with that, let me hand the floor to Barbara Oldani. Barbara, the floor is yours.
Thank you very much, Mario, and thank you everyone for joining us today. I would just like to take a couple of minutes to set the context of the proposal and the efforts that are behind it before we move on to the content. The Sustainable Sovereign Debt Hub, which my colleagues and I represent today, works to support pragmatic and market-based solutions that help sovereign issuers access more affordable and more resilient financing. So during 2024, as part of our mandate, we convened a technical multi-stakeholder working group to build shared understanding and develop best practices around debt pause clauses for sovereigns. That work culminated in a full-day conference in Madrid, hosted by the government of Spain, that brought together about 100 participants across the whole sovereign debt ecosystem, including G7 treasuries, multilateral development banks, credit rating agencies, institutional investors, technical experts, and borrower countries, DMOs. So the strong engagement, so having about 100 people flying in to Madrid for one full day to discuss the topic, demonstrates that debt pause clauses are no longer a niche instrument, but they are increasingly becoming part of the standard sovereign financing toolkit, particularly relevant in a world that is as volatile and as shock-prone as our world is today. Those conversations fed directly into the London Coalition on Sustainable Sovereign Debt agenda, an initiative that was launched in summer 2025. It's a private and public-led effort that aims to develop commercially viable contractual provisions that can strengthen resilience in sovereign lending and improve restructuring outcomes. We will hear from one of the co-chair later on the HM Treasury. The other co-chair sits with Jose Viñals, which is the former chairman of Standard Chartered. Turning on today's topic on the proposal, first of all, it is important to understand that this proposal comes from a voluntary effort from a group of emerging market asset managers whose combined asset under management represents a meaningful share of the sovereign EM debt market. Secondly, about pause clauses, in a nutshell, they are a temporary liquidity provision, a relief. They create the much-needed built-in breathing space when a shock hits that the country needs to redirect resources from debt service to crisis response and stabilization. We have already seen some successful application of debt pause clauses in the past, including the Grenada, the Barbados, for example. However, the bondholder proposal, building on those precedents, is based on the view that there is scope to improve those clauses to work and how widely they can be used. So the aim is to have a broader and a faster uptake of the pause clauses in sovereign bonds, moving towards a more standardized liquidity solution. In other words, a framework that can work across a wider range of emerging and frontier market issuers and across different types of external shocks. So scalable, replicable, quick to be implemented, rather than limited to bespoke transactions and geographies. The proposal also includes enhanced transparency provisions that require countries to regularly publish information they already hold to meet investors' needs and facilitate applicability of the clauses. Today's webinar is part of a broader engagement effort. Over the recent months, the Bondholder Working Group has consulted extensively across both private and public sector stakeholders, and the consultation and the socialization of the proposal is still ongoing. With that, let me warmly welcome you again, and I'm looking forward to hearing the proposal and a constructive discussion afterwards. Thank you.
Thank you very much, Barbara, for your welcoming remarks and for providing a bit of more context on the evolution of this proposal. Now over to you, Ru. The floor is yours.
Thank you, Barbara. Thank you, Mario, and hello to everyone joining the webinar today. So I'm Ru Ferguson, and I'm speaking on behalf of HM Treasury, where I lead up our international debt team, as well as the UK's delegation to the Paris Club. I wanted to say just a few words on the UK's involvement in the London Coalition and this pause clause proposal. So for those unaware, the London Coalition on Sustainable Sovereign Debt is co-chaired by the Economic Secretary to the Treasury, Lucy Rigby, KC, and was announced by the Chancellor last year. And as part of that, the idea has very much been to enable collaboration with private sector participants. We've been really encouraged by the level of engagement by the private sector so far in supporting developing countries to manage their debt vulnerabilities with innovative contractual solutions. On today's session for the Bondholders Working Group, and as part of the webinar today, we recognise the very strong progress that has been made on these pause clause proposals, and we've been closely engaging and providing feedback as the proposal has been developing. We see this as building on existing initiatives such as those in Barbados and Grenada, as well as our own CRDCs or pause clauses in UK export finances lending. Ultimately, we're keen to continue these efforts into the UK's G20 presidency next year to support the efforts of low-income countries in managing their debt vulnerabilities. So without further ado, I'll hand back to you, Mario.
Thank you, Ru, for these encouraging words. And with that, I think now we're coming to the heart of the matter, and we're delighted to move over to the co-chairs of the Bondholder Group, Abby and Ben, who will introduce the proposal. Abby, the floor is yours.
Just trying to share screen, one moment.
Yes, we can see the screen, but not yet in presentation mode.
Yes. Don't know why that's happening. There we go. Well, thank you, Ru, and thanks everybody for joining this webinar today. We hope that Ben and I can walk you through the key features of this broad debt pause proposal, and hopefully, seek any feedback that people want to give us after. And if you have any questions, you can hopefully ask them today or get in touch with us after the fact. But just to give you a quick highlight of what Ben and I are going to talk through, we're just going to quickly cover, again, just what the specific Bondholder Working Group has been working on and how that we fit into the overall context of the London Coalition. We'll give you a description of why we moved towards the broad debt pause approach, and then just talk through the need for transparency to make this all work, how the actual debt pause mechanics that we've designed would work in actual bonds, and what we see as the benefits for issuers and investors. So first, just to put it in context, this is a group of some of the largest asset managers who've been participating in this. We actually started work on this back in January of 2025, even before the London Coalition officially launched. We've had a very robust and extended consultation period where we've really sought input both from the other stakeholder groups who have included CRDCs in some form. A lot of the MDBs have done this, and their approach has evolved. We've talked to some of the bilateral lenders who are starting to include CRDCs in their lending. We've certainly benefited, as Barbara already alluded to, from the previous initiatives in the markets that have focused on including CRDCs, mostly in a restructuring context, but there's been great work that was done, alongside that. The challenge has been that there hasn't really been uptake, and there are a few reasons for that that we'll touch upon. And one of the main things we tried to do with our proposal is think of something that could be scaled and replicated and implemented. That was one of the key parameters that we used in terms of trying to come up with this design. So I do want to just also highlight that this is not a proposal that was meant to address solvency. We know that some countries are facing solvency issues and that there are debt issues certainly to be addressed, and there's other problems with the architecture. This is a highly engaged group of market participants who regularly participate in sovereign debt restructurings. This proposal isn't meant to address that. This is really trying to design a liquidity feature, a standardized liquidity feature for countries who are not facing solvency problems. Of course, there's always the gray area. We think that this proposal can help sometimes in those periods of ambiguity, but just to lay that out. It's not that we don't want to talk about countries that have solvency issues, and we will, but that's a separate sort of initiative. Let me go to the next slide. The key constituencies for this proposal are obviously issuers and investors. So we started by really seeking input from those two groups. Just to, there are many different approaches, and some people might say, well, why didn't you just charge an extra 200 basis points and include, multiple months or years of potential deferral options, or why didn't you just, do it another way? And I would say that our proposal was informed by what we heard were the priorities of the two groups. And so what we heard from issuers overwhelmingly, and some of the folks that work with issuers, represent issuers, or provide technical support to issuers, is that what they care about most is cost, ratings, and predictability. And there was also an additional concern about stigma. Many issuers were afraid that including something like a debt pause feature or even a climate resilient debt clause might be sending a wrong signal to markets, or might be viewed as an indication that they're thinking about having payment difficulties. So there's definitely a concern around that. What we heard from investors was that they really wanted standardization. They wanted something that would be sort of scalable and standardized across different countries. They were frustrated by the idea that there might be, very geographically specific types of CRDCs in different countries with different terms that may or may not trigger under certain events, and that they might have to then sort of become experts in all sorts of different types of climate science and health science and other issues that they're not normally doing as part of their role as a portfolio manager, analyzing and investing in bonds. So they cared most about standardization, something that would be predictable, understandable, sort of a mechanism that everybody in the market would understand. And the last thing that was a key consideration was the idea that you'd need enhanced transparency to make this all work. Because, in order to get comfortable with pausing debt for some period, you need to understand what debt is out there, what other creditors are doing, and what the plan is on the part of the issuer to resolve whatever the crisis is. So enhanced transparency was also a major concern. Fortunately, some of those overlap, some of those priorities. And the one big shared priority was that everybody wants to avoid unnecessary defaults. That's no surprise, but there is certainly a view that we've been in market situations and everybody's familiar with the concern about preventable defaults or liquidity crises. If you think back to the COVID era or DSSI type initiatives where, liquidity crises can turn into solvency issues if they, are not handled correctly. And so there's a mutual desire to try to mitigate those types of situations. And we think that this proposal can help do that. So just a quick description here of to help make the point of why we eventually evolved towards the broad debt pause approach. The evolution of CDRC adoption, whether it's in bonds like Grenada or Barbados or from some of the other creditor groups, has been an evolution. Generally, different creditors have started small and narrow, usually including sort of one type of event that's parametrically measured and has specific threshold tests and things like that. And the extent to which the lender or the lender group is involved in lending to many different countries, what generally happens is that they evolve and they start including, as time goes on, more types of crises because they realize that what is maybe important or the CRDC you might design for a country in the Caribbean is not the same as for what you might design for a country in Africa. And the future's uncertain. We don't know what types of crises might be commonplace 5 years from now that aren't in existence now. There's also a phenomenon of polycrises where one crisis, leads to a cascading series of events. So if you just have a specific clause that's tailored to one type of crises that maybe doesn't meet a threshold test, but then the country sort of suffers from a series of knock-on crises that in totality cause a very major problem, you've now designed something that doesn't work. And the issue with bonds is that they're not easily amendable. You can't sort of just go back and on a one-off basis rejigger the documentation very easily. So we believe strongly that whatever solution or whatever mechanism we had to develop had to be something that could endure. So not only did it have to be scalable and replicable, but we had to have confidence that it would be workable over the next 10 plus years and that we wouldn't be trying to do multiple iterations of this because that would just really undermine the entire effort. So just quickly, a few points on why broad and what broad debt pause clauses are, but I think, this, as we said, this effort certainly benefited from all the previous efforts that designed CRDCs and also benefited from the consultations we had, particularly with MDBs. So we understood how they were trialing different approaches and eventually started moving to a broader approach, eventually started dropping thresholds because nobody wants to be in a situation where you've written into a contract that something has to be this exact magnitude and then the country has a crisis that's that exact magnitude, but minus it a little bit, and you get into a tricky situation about whether or not this tool that you've designed to provide liquidity can be activated or not. So the broadness of the triggers can help solve that problem because multiple different types of crises can be covered, and you can design it to be streamlined, fast, transparent activation process, and the question then, I think, for us and for investors is then how do you design contractual safeguards to address fears about opportunistic or unnecessary use of such a pause clause, and how do you address issues related to uneven application of a clause or the moral hazard question about pausing one group of creditors when others don't participate. So hopefully we've addressed some of those in the design. And finally, just before I turn it over to Ben, just want to highlight that, the key driver here is to prevent unnecessary defaults. It's to provide a limited amount of liquidity for issuers that would not result in, certainly wouldn't result in an event of default. It would be contractually designed in the contract type of clause that allows them to defer payments and capitalize into the principal. It would allow sovereigns clearly to then just redirect whatever debt service that they had anticipated using over the next 12 or more months to emergency response. And that predictability hopefully will reduce risks of contagion, help mitigate sort of big gaps in capital market access where investors start to panic that a country might, default just because capital markets are shut for a certain period of time to that issuer. And that reduction in uncertainty hopefully will lower the cost of capital over time. And I think with that, I'm going to turn it over to Ben.
Thanks, Abby. Now we can get down to brass tacks and talk about the practicalities of this proposal. So what is the pause? What actually is being paused? What is the issuer getting? How is a pause requested? How is it approved? So the first off, what is being paused? What is the issuer getting? So it's about deferral of 2 semi-annual payments or the equivalent and any amortizations in that period. And this will happen via contractual provisions so that it is not an event of default. As Abby mentioned, we're aiming for a broad set of triggers. So it really is very much in the discretion of the issuer to identify that there has been a crisis of significant magnitude that might require liquidity relief, and then to ask for that relief. We feel like, as Abby said, this is helpful in that it's sort of future-proofing the concept, whatever kinds of crises might come down the pike. And it also accommodates private sector participation in initiatives like DSSI, should there be another initiative like that. We've limited the deferral to once during a bond's life. But we do recognize that there is more and more issuance that is extremely long dated, and we've considered the possibility that if we're talking about bonds that are longer than 10 years in maturity, that we might add a second period, a second deferral in a later period of the bond's life. We did not want to create a wall of payments that a country needs to meet when it's just coming out of the crisis. So important to be clear that the deferred amounts are not due immediately when the deferral ends. Rather, deferred amounts are capitalized into the principal of the existing bond. So you can think of it as an issuer automatically gets to borrow what it needs to pay its debt service on a bond, but it's under the terms that obtained before the crisis knocked in. So we're not creating that maturity wall. The issuer is going to just have a higher principal amount that they'll pay interest on over the life of the bond, and they'll pay the fully augmented principal amount at the contractual maturity of the bond. Now you can go to the next slide. So how does the issuer ask for this? What is the what is the process for investors to opine on whether it's an appropriate use of the provision or not? So one thing that we wanted to make sure of is that there's some consequentiality to the issuers asking for this for relief. We want to make sure that the relief that's given is used to deal with the crisis in question, and that means that we want to make sure that the issuer is explaining to all of its stakeholders that there is really a crisis here that needs to be met. And so in that regard, the first precondition that we ask for is that the borrower either declares a national emergency, should that be something that they can do and are able to do under their own domestic law, or they will have applied to the IMF for one of its forms of emergency financing. So we're saying, okay, this is showing that the issuer has recognized the severity of the crisis and has taken appropriate measures beyond just asking for the pause to address that crisis. So the issuer then will submit a request for deferral, and that includes supporting documentation on the nature of the crisis and the impact of the crisis on their economy, and whatever other supplemental information that IFTR would like to provide. And the IFTR will hold a global conference call where the IFTR explains the situation, and where creditors will have an opportunity to ask questions. The next precondition that the IFTR needs to meet is what we call synchronization. The idea here is the IFTR needs to demonstrate that at least 60% of the debt service in the time window that is encompassed by the deferral will be treated via similar provisions or on an ad hoc basis. And they don't need to have invoked it yet. They're really representing that either they have or they will invoke it. And again, there's a certain amount of trust that bondholders are extending to issuers on this, in that they're really only asking for a representation. I think another important point here is that we are not trying to impose our contractual terms on other creditors. We're not saying that 60% of the debt service needs to be covered by identical contractual provisions to ours. What we're saying is that the treatment needs to be comparable, that essentially that for 60% of the debt service, the money's not going out the door. So that could be via deferrals, it could be via rollover agreements. The modality, we're a little bit agnostic with respect to the modality. We're more focused on the result. And I think people who are familiar with the architecture, you can see that it's motivated by similar concerns as comparability of treatment or the IMF's requirements on financing assurances. It's less stringent than that, but it's the same motivation. The idea being that the value of this proposal the value of the pause in being able to avoid a hard default depends on the application of similar liquidity relief across enough of the debt stack to actually make a difference in the country's ability to respond to the crisis and to meet its financial commitments. So the issuer will represent that synchronization requirement has been met. There is a limited use provision in case of very severe crises, which I'll talk about in a second, but assuming that that's not the case, the other thing we're going to check for any individual bond is that the deferral does not occur in the final year of the bond's life. Now, the reason for that is really some extrinsic considerations. Extending the final maturity of the bond has a lot of difficult implications. It has some implications under rating agency methodologies. It has some implications on index inclusion. And so we just couldn't find a way around that, really. And so that restriction is something that we just needed to leave in place. But then assuming all of that is met, the last step, and this is not a step necessarily that needs to be clear, this is just something that has to not happen. If bondholders feel that the deferral request is pretextual, that there really isn't a crisis, that the synchronization representation is not credible, bondholders then can request a vote, and if the vote garners more than 50% of voting holders, the bondholders can decline the pause. Now, I know that sometimes that sounds a little scary to issuers when we talk about that, but I think bondholders on this call will recognize, it won't be unfamiliar to them, that it is very difficult to organize a bondholder vote and to win a bondholder vote on anything. So this is something that we do not anticipate would be used very often or be used lightly. And I think it's also the case that it's really important that the bondholders have to take action to decline. This is almost like in a criminal trial that if you flip the burden of proof. The party that needs to organize one of these votes has a really big hill to climb. And I think there are reputational issues that bondholders would face if they're organizing a vote to decline and there wasn't a very, very good reason for it. So this is something that I think it needs to be there in order to give investors the confidence necessary to agree to extremely broad triggers and to kind of a representation-based synchronization requirement. So it needs to be there, but it's not something that we anticipate would be used very often. And we stress that it's something that it's quite difficult to actually trigger. Abby, you can go to the next slide. I want to get back to this question of this alternative, this limited use provision. I think one concern that we heard when we were doing engagement was about, again, about this declination option. And people said, well, what if it's just a really, really big crisis? And we take the point that there are some situations where the crisis is so obvious and severe, and the extent of the damage is so easily verified, and speed is of the essence, that maybe it would be appropriate to skip the declination option, to have the pause activated more swiftly and more automatically. So what we decided to do is to say that if an issuer seeks an independent assessment, and the assessment that we're going with is the World Bank's grade report. So this is a rapid damage assessment process that's superintended by the World Bank, and they've been doing this for a while, and they've done many of them. So the issuer can solicit a grade report. Those come back quite quickly, and if the grade report shows that the catastrophe or crisis has an impact of greater than 15% of GDP, then all of the other requirements still obtain, except there will not be a declination option, and the pause can proceed without any question of that step. And you can go to the next one, Abby. So, what's the overarching philosophy here is we're looking for contract provisions that are like clear and functional and pretty easy to use, so that we can operationalize the debt pause in a way that's not incredibly cumbersome, but that also protects bondholder rights and bondholder interests. We want to make sure that these deferral requests are transparent. We know why the country is asking for deferral. We have some sense of the impact of the catastrophe on the country's economy, and we're sure that the issuer is being transparent with all of their stakeholders, with their own citizens, civil society, their other creditors, about the severity of the situation. We need to have synchronization. The whole let's just say the bargain here is, there is a cost to bondholders for deferral. There's an NPV cost, but we hope that can be offset by other aspects or other effects of this proposal. And the most important one is the reduction of the probability of hard default. But the probability of hard default will not be reduced if the pause is not implemented across a meaningful part of the debt stack. So the synchronization is really important in this respect. And again, we're not putting any kind of strong requirement about how other creditors' abilities or their modalities for providing liquidity relief, like how those work. We're really just focused on the effect and making sure that a sufficient amount of debt service is paused to really meaningfully help the country and reduce the probability of hard default and increase the probability of a quick recovery. Broad triggers, again, we need protections if there are broad triggers. It opens up the potential for opportunistic use. Again, just like we're asking people to say we're not going to trigger a declination option lightly, but we agree there needs to be a way around it in the case of very severe crisis. The same goes for the issuer. We're willing to allow broad triggers, allow the issuer a broad degree of discretion, but we need that control against an opportunistic use, and so we have the declination option for that purpose. And finally, like an overarching philosophical underpinning of this whole effort is the importance of transparency. The whole idea of investors allowing a pause, bondholders allowing a pause, and it requires some trust. It requires trust between the issuer and the bondholders. And one way to build trust, really the most important way to build trust, is transparency. We need to know, at all times, we need to know the debt situation of the debtor. We need to know when a pause is requested. We understand all the other debt that's out there. Otherwise, we can't even operationalize the synchronization requirement. We need to know that it's truly a liquidity issue and not obviously a solvency issue. We can't do any of that without transparency. We also think that transparency is good outside of the context of crisis. It helps the market operate smoothly. It helps risks to be priced accurately, and avoiding surprises is always a really good thing. And we think that countries should be capable of meeting the transparency requirements that we're asking for. We're not asking for really detailed data. We're asking for information that really every country should already have, and that it should be shared in a way that all investors get to see it, but also all stakeholders. And we think that this connects well with civil society efforts like public debt is public. So it's the one way we've put it is that we're giving up something in terms of NPV via pause, but the things that we're asking for in return, they are goods for the investor. Transparency is a good for the investor, but they're also public goods. Transparency is a public good. You can go to the next one, Abby. So then the question is, how do you get these provisions into bonds? Now, I think some people on this call may have experience with the implementation of collective action clauses. That's also it's similar, right? It's a contractual innovation, the power of which was catalyzed by adoption across most of the debt stack. In the case of collective action clauses, we had to wait for the natural pattern of maturity and new issuance to allow those clauses to propagate through the debt stack. And we ultimately got there, but it took 15 years. I think we all agree that coming up with these kinds of liquidity solutions in the face of increasingly frequent climate catastrophes, we can't wait 15 years. So we need to think big and think creatively about how we can get these provisions into the debt stack more quickly. Now, I think one advantage that we have relative to CACs is that this proposal is focused for the moment on a limited set of countries, low income, low middle income countries and small island developing states, most of which don't have enormous diverse bond debt stacks. So we're talking about issuers that maybe only have 1, 2, 3 bonds. We think that that there's an opportunity to use liability management exercises like swaps, swaps on upcoming maturities, or even using the collective action clause architecture via consent solicitations, hopefully not with any fee required, but to insert these clauses in multiple bonds at once. But we take the point that unlike CACs, we don't think we have the time to wait 15 years. So we're going to need to think big and think creatively about how to get these provisions into the entire bond stack of the countries in question. I'll turn it back to Abby to wrap up.
Sure. Yeah, and just to follow up on that one point, both partly that whole idea about the synchronization option also helps address the issue of implementation. I mean, there's no chance that an investor would be sort of willing to be the only bond investor if there's multiple series of bonds outstanding and you know that there's other creditor groups. You don't want to be the only creditor to be invested in a bond with a pause clause if that architecture doesn't exist, or if a similar provision doesn't exist in the other outstanding liabilities. That synchronization requirement helps protect that and helps with implementation because the extent to which a country does just include it on a one-off basis in a new issue, they'd be unlikely to trigger it until they sort of get to a critical mass of their debt stack with some sort of architecture and or be able to coordinate with other creditor groups. So it sort of removes that first mover fear on the part of the investors as well, or helps address that anyway. So just to sum up, hopefully we've made a decent case about why we chose to go broad. That was the first big decision we made. If we didn't highlight it enough, we felt that one of the most important things that we could do to address the way that the market was developing was to think about what would be scalable and replicable and workable in the market, but also, perhaps bondholders need to be the one creditor group that ensures that all the different actors who are potentially going to provide liquidity to a country can sync at the same time. If we continue down a road of developing climate resilient debt clauses with very bespoke triggers that maybe only trigger if the hurricane's air pressure was of a certain magnitude and therefore it didn't trigger for bonds, but then the other creditors are going to trigger, I think we're going to get into all sorts of intercreditor issues, and many investors will just try to shy away from the initiative altogether. So a benefit of the broad approach, if bondholders take it, is that it will ensure, if there's a real crisis, that all the different creditor groups can sync and provide liquidity at the same time. We also think that this will just be, help with, it'll become a predictable mechanism that investors it'll be clear, it'll be transparent, it'll be something that's relatively standardized. So investors will understand if country X gets into a certain situation, what's going to happen. They can evaluate the severity and listen to the issuer's request for a pause, and that it'll help ensure that that the market's familiar and ready to engage in those kind of discussions. And we really did try, as I said initially, to balance the needs of investors and issuers. So again, the entire structure of this proposal was designed not to raise the cost of capital for issuers, not to result in ratings downgrades, not, certainly not to trigger an event of default, and to ensure that there are benefits in this proposal for investors as well, most of which come from the enhanced transparency side of the equation. But together we think that it's sort of a great balance for both investors and issuers. I think with that, I'll turn it back to Mario.
Abby and Ben from the Bondholder Group, thank you so much for joining us today and walking us through the mechanics of the proposal. Great presentation. I think you've made a very good case for broad clauses and how they benefit issuers and investors at the same time, and also contribute to the wider global public good of transparency, I think. So very clear, very great presentation. Thank you very much. I'm sure there's still questions out there. And let us turn to the participants and see what we have in the Q&A box. So with that, Stara, I'll hand the floor to you for a Q&A with the panelists.
Thank you very much, Mario, and thank you, Abby, Ben, Rue, and Barbara, for a great presentation and setting the scene so well. Yes, we have a few questions, and I encourage the audience members to please post more in the Q&A if you have more questions. The first one that I'm going to ask you, Ben and Abby, is related to what you were just saying. And it relates actually to how difficult sovereign debt innovation in the sovereign debt markets is, and how many constituents need to be part of the process, as we saw with the introduction of collective action clauses, which, the initiative was back from like 2000 to 2003, and Ben explained how many years it took for those to be quite fully adopted and also endorsed even by the IMF. It took years. It also takes a village. It takes the issuers recognizing the benefits and the need for the innovation. It takes advisors explaining, and it takes civil society embracing. It takes advocacy, and it takes, of course, the market to show that it's willing to adopt these provisions, and trying to make these provisions in a way that will not raise the cost of capital and make it prohibitive. So one of the questions that we got is specifically about the cost. The question is, could you speak to the expected pricing impact? I know you have, but maybe more specifically, the pricing impact of the pause clauses. In my experience, it's really the binding constraint from lower middle income countries, why we are not seeing these adopted. And is there any chance that these could be adopted retroactively, which I think also goes to the implementation plan? So Abby, Ben, turn it to you. Thank you.
Abby, do you want me to talk about cost?
Yeah, sure.
So our hope is that there's no cost imposed on the issuer, to include these pause clauses. We recognize that obviously there is an NPV cost to bondholders of a pause, but we hope that there are countervailing benefits that will offset that cost. We actually, my colleague and I, have written a paper that comes up with a calculation for what the ex-ante NPV cost of the pause would be absent any compensating impacts. And it's not large, it's not trivial, and it's not large. I think for the typical kind of B credit 10-year bond, we calculated the range of actuarial pricing impact of between 1 and 1.5 points, which is like 16 to 20 basis points. So it's not huge. We hope that that is offset by some of the other benefits that the proposal presents to investors. Number one, the reduced probability of hard default. The deadweight loss implicit in a hard default is very, very large. And any of the bondholders who've been on this, who are on this call, who have been on restructuring committees and been involved in restructurings, and I can see in the names there are a number of you, they can tell you how, just in terms of their own time, how difficult it is to go through one of these restructurings, and just the damage it's done to the economy of the issuer, that then impacts recovery. So we really want to avoid those. So if even we reduce that probability by a small amount, that might be enough to offset a lot of the actuarial costs. In addition, the transparency requirements in the proposal are also something, like I say, they're sort of a public good, but they are also a private good to bondholders, because more information always makes our job a lot easier. It makes it more likely that the credit decisions that we're making are correct, and that we're not going to be met with unpleasant surprises down the road. So I think if you think of the comparison between a bond today with the disclosure standards that we have today, with the probability of hard default that we have today, and you compare that to a bond with the pause clauses, and that has maybe a lower probability of hard default, and where suddenly bondholders have much better visibility into the issuer's debt stack and economic performance. I think the comparison between those two states of the world might lead you to the same price for both those bonds. That's our hope anyway.
Great, thanks. We've had several questions around the synchronization requirement, not surprisingly. First one, if you could clarify, I don't think it was clear in the presentation, what is the debt? What is the sort of the denominator of the debt that you're looking at for the requirement of the 60%? I think it just said 60% of debt. Can you be a little more clear on that, specifically also around MDB debt and kind of what's captured there? Abby or Ben?
I'll start, Ben, and you can chime in. Yeah, we're so in the weeds, sometimes we don't remember what points we need to address specifically. Our intention is not to include MDBs at all in that calculation. We assume that they have lots of other means to provide emergency financing, and historically are always doing that. It's not our intent to try to capture any of the MDBs as defined in our proposal, which you'll see as if you continue to read the documents, but the World Bank, IMF. And we're not even trying to distinguish between whether the loans that they've extended are concessional or non-concessional. The extent to which the World Bank, IMF they're not included in our sync analysis. What we're including in the sync analysis in terms of asking the issuer to represent that they've achieved or are moving towards achieving some form of pause are bondholders, bilaterals, and banks. And we've actually done a lot of work on that by using the universe of countries that we think are applicable for this. So using MB Global countries that have issued debt in international capital markets, looking at those countries which are small island developing states, low or low middle income countries. There's approximately 32-ish, moves up and down every now and then, but something around that range, 30 to 35 countries. In our analysis, all of them except for one can sync with just bondholders and some form of bilateral participation. So, some of these countries, most of their debt is in bonds. Some of them, most of their debt is with bilateral lenders. But we're pretty confident that this is. We haven't tried to design something that's unworkable. We've tried to design something that can give bond investors and other creditors comfort that when they're providing the liquidity relief, that they're not the only ones providing it.
On the question of MDB, of why are we excluding MDBs? Because I think sometimes people ask that question. I think the main idea here is that we believe that by their mission, these are institutions that are going to be providing liquidity in these situations. I think there's also the complicating factor of preferred creditor status, and we don't want to step on anybody's toes with respect to that. Obviously, we'd love it if MDBs explicitly include pause clauses in their lending. We would embrace that, but I think the feedback that we got, from the official sector, and I think we think it's valid, is these are mission-oriented institutions that are already providing liquidity when a country's in a difficult spot. So it's sort of, they're kind of already there.
And to a large extent, many of the MDBs, certainly the World Bank and the regional development banks, have included climate resilient debt clauses in their lending. but they face a different set of challenges in terms of how they approach it, because it's for them it's a balance sheet issue. So they have to define, they've taken different approaches to how they define the universe of countries that they extend climate resilient debt clauses to, or in some cases maybe the magnitude of the lending, or the how much of their overall loan book they can have that includes CRDCs, because they have to worry from their standpoint as an institution about how the rating agencies are going to view them, and the extent to which their entire loan book had climate resilient debt clauses that all got triggered at the same time might risk their own ratings from a balance sheet standpoint. So we're not trying to force the MDBs into having the same exact architecture as we have. They have their own approach.
Great. We have quite a few questions, so I want to try to get through them. Just one more point on the synchronization, or at least the one that I can see right now. It also relates to you kind of touched on this, but maybe you can clarify legacy bonds. And we've talked about how you want to think big, and try to get these implemented through liability management or other. Could you just maybe elaborate a little bit more clearly on that? Why and how that would work, and how would you kind of address an issuer? What is the plan to bring this forward?
Sure, I'll start, and Ben, maybe you can just join in. So first, I want to say, going back to sometimes when you just think about this in the abstract, you can kind of get lost and think that it's much too hard to implement. But we're very practically looking at which countries. This is not which countries actually issue debt in international capital markets. How many bonds do they have outstanding? Is it feasible to do or to consider liability management transactions? So for that, many low-income countries don't issue bonds in international capital markets. In the MB Global, there's only 3 low-income countries. Most of the countries are low-middle-income countries. There are some small island developing states, but it's important to look at the specifics of which countries actually have bonds outstanding. Many of those countries have just a few bonds outstanding. In most cases, I think if we did the average or the mean, it's sort of like these countries have typically 3 or 4 bonds outstanding. There are a few countries that might have very well-developed yield curves with 16, 17 bonds outstanding, and that would probably prove a little bit more challenging for a liability management transaction. But there's many countries in this universe, or this target group of countries, that have 1 bond outstanding. And maybe are considering another issuance, and it might be a good opportunity to think through, how best to approach that when they're coming to the market the next time. It's also obviously, you could consider this in a restructuring context, and there is an ability, as Ben already alluded to. I'll ask him to go into that in a little bit more detail, to sort of retroactively try to implement this, but clearly that would be a higher stakes kind of approach, which would definitely require investor buy-in. You'd need, a significant, a vast majority of the investors to sort of approve this. And that's where the whole transparency and the other types of contract updates that we're asking for come into light and really are important.
Yeah, we do have this tool of collective action clauses, and it could be used in the context of a consent solicitation. I think we've looked into the question of whether using collective action clauses to implement something like this, where it really is, it's not prejudicing the interests of bondholders, that it would not be an event of default, it wouldn't lead to downgrade. So you could use the collective action clauses in that context, but as Abby said, it's going to require a real outreach to investors to build the majorities required. But I think it is worth investigating, because it's a very powerful tool for getting these changes implemented in a lot of bonds at one stroke.
And that's also where we think that the investors who participated in this group and have designed this proposal can really help. We have some of the largest asset managers represented in our group who are very active new issue buyers, have vast amount of assets under management in the dedicated emerging market debt space. We will be advocates for this, and we will work with issuers to help get this done.
Exactly. And again, it takes a village. So we have a very large group of institutions, people who would be really, really standing by any issuer that wanted to come forward and seek assistance. Okay, we have so many questions, but we have one about ratings agencies. And I know we don't have a ratings agency on the panel, but I know that you've been consulting with them. So here's the question. would bonds with pause clauses have lower ratings? Because that would certainly not be attractive to
No.
our issuers.
No, that was a gating issue for us, that we needed to make sure that we could do this in a way where there would not be a ratings notch impact for a bond that has these clauses. Before, like our ultimate end state is you want the entire debt stack to have those provisions, so there wouldn't be a question of notching. It would just be a question of whether it affects the outright rating. But we don't want notching or an effect on outright rating. And I think we've had conversations with the rating agencies that have been generally positive in this respect, and we've made some adaptations to the proposal to get to that outcome. I mean, for example, the restriction on pausing bonds with less than 1 year to maturity is an example of that.
Abby, do you want to add anything to that? Otherwise, I'm going to ask a really simple question, and then
No,
there
go
are
ahead.
other questions in the chat that I think we will have to respond to with written answers. Some of them are quite technical. So here's the easy question. Are the slides going to be made available so that participants can consult them?
Absolutely, yeah. We have it as a PDF, so anybody can have them.
That's great. And then what we might do with these additional questions is add them to the facts sheet, the frequently asked questions sheet that the Bondholder Group has already created. And all of this information, well, the proposal, the facts sheet, and maybe potentially these slides, we can make them all available on the SSDH website under the London Coalition tab. So all of that information will be available, and we can also reach out specifically for the questions that we weren't able to answer. And also on that website page, there is a link or a click, email to the SSDH team, where we are always happy to get more feedback. So I believe that is team@ssdh.net. So everyone is encouraged to continue with the questions and suggestions. And just so you know, many of the suggestions also have to do with the trigger formation, but we will, of course, make all of this available to the group so that you can review that. Thank you so much. I think that was very helpful. Great questions. Thank you, audience. I'll hand back over to Mario to close the session.
Not much to say. Thank you very much to both of you from the Bondholder Group, Ben, Abby. Thank you, Starla, for managing the Q&A session. Thank you, Rue, for joining us today. And thank you, Barbara, for the welcoming remarks. And of course, thank you very much to the participants for asking very good questions. I think it was a very exciting conversation. As Starla mentioned, please do reach out at team@ssdh.net if you have further questions or just want to get in touch. We are here. Thank you very much again for joining us today. I wish you a wonderful day or afternoon or evening, wherever you are.